If this one square represents a value of $100 billion, then this is how many of them we need to visualize the value of an Apple stock. This would represent the value of a total gold around the world. This would represent the global GDP. And this would be the value of a whole derivatives market. Hello and welcome to Derivatives 101. My name is Anastasia and I've been trading for the past 8 years. During this time, I went from being on the edge of throwing my laptop out of the window and feeling powerless about my results to consistent full-time trading. One of the breakthroughs in my trading was connected to shifting from Forex to futures market. And hence in today's video, we will be exploring the exciting world of financial derivatives and pretty much everything that you need to know to start trading them. We will break down the complex concepts and provide the practical, real-life examples that make understanding derivatives easy even if you are a complete beginner. So whether you are new to the finance world or you are looking to enhance your trading knowledge, you are in the right place. Let's start with the fundamental knowledge. A derivative is a financial contract whose value is derived from the value of something else, also known as the underlying asset. Essentially, the value of the derivatives moves in sync with the price of the underlying asset. For example, imagine that you are betting on the price of gold. If gold's price rises, your derivative contract's value rises as well. On the other hand, if gold's price falls, so does your derivative's value. It's pretty much like betting on the outcome of a football game. You don't own the game or the ball itself, but your bet is tied up to the result of the match. In derivatives, the value is always connected to the underlying asset. The underlying assets can take really many forms. For example, stocks, commodities like oil, wheat, gold, etc., currencies, bonds, interest rates, or indices like S&P 500 or Dow Jones. The underlying asset is essentially the backbone of every derivative. Without it, the derivative simply wouldn't even exist. For example, if you are trading the derivative based on the price of wheat, the value of this derivative will go up or down depending on how the price of wheat changes in the market. All derivatives come with what is called the expiration date, also known as a maturity date. This is the last day when you can trade the derivative or make changes to the contract. After this date, the contract will settle and all positions will be closed. Some derivatives settle by physically delivering the underlying asset, which means that at expiration date, the quantity by the underlying asset specified in the contract will be delivered to the buyer, while others are cash settled, meaning that the difference in the counterparty's position will be settled in cash rather than delivering the underlying asset. So why do derivatives exist in the first place? Here are the two main purposes. First is hedging, reducing the risk. For example, if you're a wheat producer, you may want to protect yourself from the risk of falling wheat prices. You could use a derivative to lock in the price now, ensuring that you will be able to sell your wheat at a good price in the future. Second reason is speculation, pretty much betting on the price movement themselves. This is where traders or investors seek to profit from changes in the price of the underlying asset. If you believe that the prices of wheat will rise, you may buy a derivative based on this prediction. Let's have a look at the real-world example of hedging. We will have the wheat producer on the left and the cereal manufacturer on the right. Undeniably, the wheat producer is interested in selling their wheat by the highest prices possible, while the cereal manufacturer wants to see the price of the wheat going lower to cut the production cost. Let's now assume that the wheat producer sells 5,000 bushels of wheat to a cereal manufacturer at a price of $12 per bushel for delivery in 6 months from now. For derivatives, the pre-specified price is called strike, and pre-specified date is called maturity. If the price of wheat rises to $15, the producer benefits because they have locked in a really good price. But on the other hand, if price drops to $10, the manufacturer wins because they get the wheat at a really cheaper price. This is a simple example of how hedging works in real life to protect businesses against the unfavorable price movements in the market. It also allows to keep the prices of your favorite cereals on the store shelves more or less stable over a longer period of time, despite the fluctuation in the prices of raw materials. There are 4 main types of derivatives. Forward contracts, which are the customized contracts between two parties to buy or sell an asset at a set price or the future date. Future contracts, which are standardized contracts that are traded on exchanges such as, for example, Chicago Mercantile Exchange. Option contracts, which give you the right but not the obligation to buy or sell an asset at a set price before the specified date comes. And swaps, agreements where two parties exchange cash flows based on different financial instruments, such as, for example, interest rates or currencies. Forward contracts are agreements between two parties to buy or sell an underlying asset at a set price at a future date. What's important to know is that these contracts are customizable and because of this, typically not traded on exchanges, which means they carry more counterparty risk. However, they're quite useful for hedging as the terms are negotiated between the buyer and the seller directly. This is how our familiar example would look like if the two counterparties use a forward contract. This would be more of an agreement than a contract to trade 5,000 bushels of wheat in 6 months from now for the pre-specified price of $12 per bushel, regardless of wheat price at the moment in the future. However, this would carry the risk because, as we already know, it's a self-regulated agreement between both parties. The second type of derivatives we discussed today are the options. Options give you the right, but not the obligation, to buy or sell the underlying asset at a pre-specified price before a set expiration date. There are two main types of options: call options, which give you the right to buy, and put options that give you the right to sell. Let's say that you are a wheat producer again and you think that prices of wheat might go down in the future. You might want to protect yourself against the possibility that wheat prices will fall in the future, and in this case, you could buy a put option, in other words, a right to sell a wheat at the pre-specified price within the next 6 months. Therefore, if during this time the prices of wheat drops to $10 per bushel, you can still sell your wheat for $12 per bushel because of your option. On the other side of the coin, if the producer would sign a contract to have a right to sell 5,000 bushel of wheat for a strike of $12 during the next 6 months, the manufacturer would have to, without a choice, buy the agreed amount of wheat for the pre-specified price anytime during the next 6 months when the producer decides to exercise the contract. Even if the price of wheat would fall and the market price, let's say, would be $10, the manufacturer would still have to buy it for $12 since the contract was signed. However, if in the meantime the price of the wheat increased to $15 per bushel, the producer will have a right to change his mind and instead to sell wheat to another manufacturer for the higher price. Remember, it's the right, not the obligation. That's essentially why it's called the option in the first place. This leaves the cereal manufacturer rather unhappy, I would say. And this is where something called premium comes in light. In simple terms, the premium in options contract is the price you pay to buy the option. It's like the cost of buying a ticket that gives you the right to either buy, call option, or sell a put option, an asset at a pre-specified price within a set time. So when you buy an option, you pay a seller a premium upfront. This is a non-refundable fee, whether or not you actually use the option. If the market moves in your favor, you could make a profit, but if it doesn't, the most you can lose is a premium that you paid. So let's say that producer had to pay $1 premium for every bushel of wheat in order to buy the put option. Now imagine that 6 months pass and the wheat actually increased in price to $15 per bushel. Logically, it doesn't make sense for the wheat producer to sell it at $12 per bushel, and he chooses to not exercise the contract. Instead, he finds another cereal manufacturer who buys the wheat from him at the market price of $15. Producer just saved and made $15,000 by selling his product at a higher price. But he also needed to pay premium to the cereal manufacturer number one, which comes down to $5,000. So his net profit is $10,000. Now, let's take a look at the call option, which gives the right to buy an underlying asset at a specified price known as a strike price. In this case, suppose that you are a cereal manufacturer and you believe that wheat prices are likely to rise in the next 6 months. You could buy a call option to lock in a purchase price of $12 per bushel. However, if the market price of wheat drops to $10 per bushel, you may simply not use your contract and buy from someone else at the higher market price. And despite the deal not being settled, wheat producers have still made $5,000 from the premium, and everyone is pretty much happy. Now, let's discuss how options can be used for hedging risks in the stock market. In the case of the stock or commodity position, an investor may use options to protect themselves against price movement in the underlying asset. For instance, if you own shares of the company, but you are concerned about the potential of a drop in the price, you might buy put options as a form of insurance. This gives you the right to sell the shares at a specific price, ensuring that if the price falls, you won't suffer the significant losses. Let's say that you own 100 shares and the current market price is $50 per share. You buy the put option to have an ability to sell your shares at $45 per piece, and you pay $2 per share as a premium. And oops, the company has made some wrong decisions, and the price of your shares dropped to $40 per piece. Your net loss on shares price would be $1,000. However, you still have your put option, which allows you to get rid of your shares at $45 instead of $40. This saved you $500 loss, and combining this premium you paid, a total loss that you suffered now is only $700, which is 30% of money saved. Similarly, if you anticipate the rise in the prices of the commodity you already hold, you could buy call options to lock in a future buying price at a lower level. This is a practical way of managing risking without having to sell or buy the underlying asset immediately. Let's now move on to another type of derivatives, swap contracts. A swap is a contract which two parties agree to exchange cash flows or liabilities over a period of time. Swaps are often used in interest rate or currency market. They can be used to manage exposure to fluctuations in interest rates or to exchange fixed rate debt payments for floating rate payments. Swaps are frequently used by companies and financial institutions for managing risks associated with their financial or currency exposure. To illustrate the next example, let's meet Sam and Johnny. Sam is a risk taker, while Johnny is a calmer one and prefers predictability. On their birthdays, both boys got horses. Johnny got the one on the wheels, while Sam received the rocking horse. The horse on the wheels, though, has been given Johnny, who loves stability, lots of anxiety. Sam, on the other hand, got extremely bored of his rocking horse. It can't go anywhere, and being pushed to stay in one place with his risk-taking nature was driving Sam nuts. Hence, boys found a solution. They swapped horses to meet each other's character needs. In this swap, Sam has assumed the risk, while Johnny has exchanged uncertainty for stability. This fundamental exchange, the risk for predictability, is the core principle behind all swaps in the financial system. Years passed, Sam and Johnny grew up, but some things stayed the same. Sam is still the risk taker, and Johnny still prefers to bet on stability. Fast forward 20 years, and Johnny now owns a local store, while Sam has become an investment banker. Johnny takes out a loan with an interest rate of LIBOR plus 3%, which would be quite manageable, except that LIBOR is a floating rate, meaning it changes. LIBOR is essentially the interbank lending rate that fluctuates daily, affecting the cost of borrowing. As a result, Johnny never knows exactly how much interest he'll owe each month to the bank. One month, he might pay $2,400, the next $1,900, then $2,000, and this uncertainty drives him absolutely crazy. First, because he hates risk and has no way of knowing how high the interest rate might go. Second, because he values predictability and wants to budget his expenses with certainty. So, Johnny turns to his friend Sam for help. Sam suggests they swap the variable rate for a fixed one, just like they used to swap risks as kids. Under this agreement, Johnny will pay Sam a fixed $2,000 each month instead of making fluctuating payments to the bank. In exchange, Sam will cover the variable LIBOR-based loan payments. This swap eliminates Johnny's risks and gives him the predictability he wants. Now, what's Sam's benefit in helping? He's receiving $2,000 per month from Johnny. If the LIBOR-based loan payments to the bank end up being less than $2,000, Sam keeps the difference as profit. But if the floating rate rises, the payment exceeds $2,000, Sam has to cover the extra costs himself. If that happens too often, he could face significant losses. This example highlights why swaps require careful risk management and strategic planning. They are widely used in insurance, credit default swaps, and other financial transactions, all built on the same fundamental principle: trading risk for predictability. By the way, this was an example that I took from Mr. Patty Hirsch, so all credits go to him. Since now, after this basic simplified example, you understand the principles of swaps, I suppose let's now have a look at how swaps actually work in the real world. In this example, we'll explore how companies can cleverly reduce their borrowing costs to using swaps. Specifically, we'll focus on the interest rate swaps for this example, which are just one type among many others. Let's say we have two companies, Company A and Company B. Both are looking to borrow $5 million each for expansion. However, they have different preferences for interest rates. Company A prefers a variable rate because it believes rates may decline, making a floating rate beneficial. Company B, on the other hand, prefers a fixed rate, similar how some people choose a fixed rate mortgage for stability, while others opt for variable rates. Company A, being large and well established, approaches Bank A, which offers the following: fixed rate loan at 7% or variable rate loan at LIBOR. Company B, being smaller and less well known, approaches Bank B, which offers the following: fixed rate loan at 10% or the variable rate loan LIBOR plus 1. For example, if LIBOR is 8% in 3 years, Company B would pay 9%. If LIBOR rises to 10% in 5 years, the cost would be 11%. Alternatively, it could lock in the fixed rate of 10% for predictability. At first glance, Company A might just take LIBOR, while Company B settles for 10% fixed. But although these companies don't know each other, a swap bank can step in to improve their loan conditions. The swap bank proposes a different approach. Company A, instead of borrowing the LIBOR, takes a fixed rate of loan at 7% from Bank A. Company B, instead of borrowing 10% fixed, takes variable rate loan at LIBOR plus 1 from Bank B. At this stage, both companies have loans, but the opposite rates from what they actually wanted. Here is where the swap agreement comes into play. The swap bank sets up two separate agreements with Company B that the swap bank pays Company B LIBOR, matching its floating loan, while Company B pays the swap bank 8.5% fixed instead. This effectively converts Company B's variable loan into a fixed loan at 8.5%, which is better than the original 10% that were proposed. On the other hand, the swap bank receives LIBOR from Company A, turning its fixed loan into a floating one. In return, it pays Company A a fixed 8%. This effectively lowers Company A's borrowing cost from LIBOR to LIBOR minus 1, making it cheaper than borrowing directly from Bank A. How does the swap bank profit? The swap bank earns 0.5% from this arrangement. It receives 8.5% fixed from the Company B and pays 8% fixed to Company A, keeping 0.5% difference. LIBOR flows in from Company A and flows out to Company B, making it neutral. Even if LIBOR fluctuates wildly, the swap bank continues to collect 0.5% on $5 million, generating steady revenue. What the clients gains? Well, Company B originally faced a 10% fixed rate, but now effectively pays 9.5% fixed, a 0.5% savings that adds up significantly over time. Company A, on the other hand, originally had to pay LIBOR, but now it gets a better deal at LIBOR minus 1%, lowering its costs. This works because of comparatively advantage. The swap banks understands both clients' borrowing strengths and crafts a deal where everyone benefits while it makes a small profit for itself. This example demonstrates how swap contracts improve loan conditions and reduce borrowing costs. As mentioned earlier, swaps are at the heart of many financial operations, helping businesses manage risk and optimize their financing. That's all for today, folks. In the next class, we will explore our primary focus, the future contracts, and everything you need to know to trade them successfully.